Hi, this is Andy from Rookie Investor, and in this video we will analyze how to read an income statement. An income statement will show you the profit or loss a company generated over a certain period of time, usually a quarter or a year. It is one of the three core parts to look for in a financial statement, with the other two to be the balance sheet and the cash flow statement, which we have analyzed them in different videos. In this video, we will go over a few income statements, the importance of them, how to analyze them, and what are the key metrics you need to focus on. Allow me to start by saying that you can access any income statement of a publicly listed company. Many websites, aside from the company's own website, will provide the info. The easiest way is through Yahoo Finance. Once in the company's page, click Financials and then Income Statement, or TradingView, which again you click Financial Statements, Income Statement. There are a plethora of investment related websites where you can get this information, and also you can visit the website of the company and find them there. All the companies post their quarterly financial statements and of course their 10K forms, which income statement is a part of. Anyhow, for this video we will use TradingView as it provides detailed information about all the listed companies. In addition, we will use Amazon's income statement. The income statement focuses on four key areas: revenue, expenses, gains, and losses. It is by far the most populated part of any financial statement, and you could get a bit overwhelmed just by looking at it. But after we break it down to parts and point out the sections you need to focus on, it will seem much easier. All income statements start with the total revenue of the company, which is also called the top line since it's the first number on the income statement and is the money the company made from selling its goods and services. In our example, we use Amazon, and their figure is $469.82 billion for the year of 2021. It goes without question that every company has expenses to operate, produce, and sell its products. Those costs are summarized under the name of total operating expenses, and in the TradingView format, this figure will be found on the bottom of the report. For 2021, Amazon had $444.88 billion in total operating expenses. Now let's turn our attention to gross profit, what it is and how it is calculated. Gross profit is the profit a business makes after subtracting all the costs that are related to manufacturing and selling its services or products. In the TradingView, this bears the name cost of goods sold, and its value for 2021 was $272.34 billion for Amazon. There is always a minus sign prior to the number, as this number is always negative. Once we subtract the cost of goods sold from the total revenue, we will get the gross profit. In our example, that number is $197.48 billion for 2021. Moving down the statement, we have the operating expenses, which, as you can guess, are expenses associated with running business operations like paying salaries, advertising, rents, office supplies, and so on. These expenses are not taken into account in the cost of goods sold and need to be further deducted from the gross profit in order to get the operating income. So as you can see, from the $197.48 billion Amazon made in 2021, if we subtract the operating expenses, we get the operating income, which is $24.94 billion. Amazon is fortunate enough to have some non-operating income. In many companies, this is usually a negative number, as it was for Amazon in the past few years. This section includes interest paid on debts, and this is why the majority of companies have negative non-operating income. When you see a positive number here, this is income that has been generated from activities not related to its core business operations. This usually is dividend income, gains or losses on investment the company made, and so on. Adding operating income with non-operating income will give you the pre-tax income, which is the company's revenue after we deduct all operating and non-operating taxes, which is considered a more accurate measure of business performance and health. As it is well known, all companies have to pay taxes, some less than others, but in our case, Amazon for 2021 paid $4.79 billion. Deducting those from the pre-tax income will get $33.36 billion. The net income of the company, which is the most important financial metric as it reveals how much money the company made after all costs. It is also called the bottom line since it's the last number that can be found in the income statement. Again, TradingView uses a different format, but all the numbers and columns of the actual report can be found here. Now that we went through the income statement, let's focus on the key metrics that determine if the company is strong or weak financially. First, the total revenue, which as we mentioned is the money the company made after selling goods and services. A solid business will have its total revenue increase over the years. Second, the total operating expenses, which are the total expenses that are incurred over a given period of time as a result of normal business activities. This number needs to always be lower than the total revenue. If it is not, it is a huge red flag for the health of the business. Third, the gross profit, which is the profit a business makes after subtracting all the costs that are related to manufacturing and selling its services or products. We want to see a positive and a growing number here as well. Fourth is the operating income, which is measuring the amount of profit generated from business operations after deducting operating expenses such as wages, depreciation, and cost of goods sold. We want to always see a positive and a growing number over the years here as well, as this means the company is making profit. A negative number here means that the company is operating at a loss. In our example, Amazon is producing a solid $24.94 billion for 2021, which means the company is generating profits and they are up from previous years as well. Fifth, net income. As we mentioned above, the most important metric in the income statement is the net income. Solid companies will always have a positive and a growing number in this section. Last, two metrics that are highly advisable to calculate and are good indicators to analyze a company's income statement are the gross margin and the operating margin. Gross margin shows whether the company's sales are enough to cover their costs. To calculate the gross margin, you need to divide gross profit with gross revenue. In our case, these numbers are 197.48 billion divided by 469.82 billion. The number we get is 0.42, and since we refer to this on the percentage base, this is 42%. That means that for every dollar that comes to the company, Amazon makes 42 cents. The other metric to calculate is the operating margin, which measures how much profit a company makes on a dollar of sales after paying for variable costs of production, such as wages and raw materials, but before paying interest or tax. To calculate that, you need to divide the operating income with the total revenue. In our case, these numbers are 24.94 billion and 469.82 billion. The number we get after we do that calculation is 0.053. That means that for every dollar of sales, Amazon makes 5.3 cents. This also varies depending on the business. However, a 10% operating margin is considered average, a 20% margin is considered high, and a 5% margin is low. Typically, we want to see operating margin around or above 15%. To mention here that TradingView and other websites provide these metrics so you don't have to calculate them yourselves. If you click statistics, you will find many useful ratios, including the gross and operating margin. Now that we know the key metrics we need to focus on, let's quickly review a company and apply what we learned. Obviously, Amazon was a great example of an extremely healthy and prosperous company, but not all companies share the same fate. For example, Bed Bath & Beyond. Looking at their income statement and keeping in mind what we learned, we see that their total revenue has been decreasing over the years. That is a red flag as it shows a shrinking company, as each year it generates less revenues from the sales of its goods. Their total operating expenses are lower as well. However, the biggest issue here is that the total operating expenses are higher than the total revenue, meaning the company spends more than it makes. Gross profits are declining year over year, and the operating income is negative for 3 consecutive years. The picture already is painted, but let's move on. Same story with the net income of the company, negative for 4 consecutive years. Last, let's check the gross margin and operating margin. Here you will see that the gross margin is positive and it's above 30%, 33.31% to be precise, which means that the company is making profits from selling goods. This means that the company has high operating expenses, or as they called, selling, general and administrative expenses. These expenses are not directly related to the company's production process, but instead represent the costs related to sales, general and administrative functions that keep the company running. These are rent, utilities, marketing, accounting, legal, and so on. And it's quite true looking at the statement. Their operating expenses remain high relative to their revenues. Last, the operating margin, which as you may recall from earlier, we want to see a number of 15 or above, it's negative 1.57, meaning that Bed Bath & Beyond, for every dollar of sales they make, they generate a loss of $1.57. Needless to say if this company is considered a good long-term investment or not. Let's check one more company, Twitter. The total revenue has been on the rise with the exception of 2017, but overall is growing steady. Gross profit follows the same path, however when it comes to operating income, as you can see, it is quite volatile. The company had some years of the negative, 2015-2016, growth in 2017 and 2018, and then in 2019 it had a small decline in operating income, but still on the green. But in 2020 there was a 92% drop on it, which recovered in 2021. Volatility in operating income is not a great sign. And as it was expected, looking at the net income, which as a reminder is the most important metric of the income statement, we will see that the company is losing money. Someone could say that 2021 was better than 2020, but still the company was not profitable for 3 out of the last 5 years. Both gross and operating margin are positive. One is at 64.6 and the other one is at 5.38. Twitter has definitely raised some red flags and it has been quite a volatile company over the years. Keep in mind that in order to determine the financial stability of a company, you need to look for the key points in the entire financial statement, which is broken down to 3 parts: income statement, balance sheet, and cash flow. We have created videos for all. You can find them on the description or in the video cards. I hope that this video really helped you familiarize yourself with income statements and the key points to look at. If it did, please hit the like button, and if you're interested in more content, make sure you subscribe.